Gold is approaching a massive liquidity zone right now, and smart money, they are already gearing up for their next big move. I'm not going to waste your time with the long intro today. My primary focus for this explainer is a very specific trade setup targeting a highly engineered liquidity pool. But there is one absolute condition that has to happen first. Look, most retail traders are staring at the completely wrong level right now, and frankly, they're about to become the liquidity. Let me show you exactly where the institutions are actually aiming.
$43.66. I want you to burn this number into your brain. That is the ultimate buy-side liquidity target for gold today. Why is this exact level so absolutely critical? Because institutions are deliberately drawing price right to it. But here's the problem, and you have to be ready for this. The market is going to lay a massive trap before it ever gets there. So we're going to map out exactly how to trade alongside smart money and keep you from getting caught in the crossfire.
All right, let's give you the outcome before we even dive into the full explanation. From a macro perspective, our higher timeframe bias on the daily chart is heavily bearish. We are sitting in a macro distribution phase. However, our primary focus for today's intraday setup, it's actually a bullish retracement phase. We are looking to buy the short-term counter-trend move before that larger, heavy macro bearish trend resumes.
When we zoom out to the big picture on the daily time frame, you can see a major market structure break to the downside is already validated. It smashed right through that major swing low around $40.85. But take a close look at that recent extremely aggressive liquidity sweep down near the $40.35 macro lows. Smart money engineered that sweep specifically to accumulate long positions, which shifted the short-term order flow upward. So right now, we are in an efficiency-seeking phase, basically delivering a bullish move inside a larger, higher time frame bearish expansion.
So, this opens up a pretty fascinating question, right? Why on earth is smart money targeting 43.66? Why engineer this specific complex path upward right now, only to inevitably resume the macro downtrend later? Well, the market is actually flashing a huge warning signal, and the answer to that question is sitting right inside the premium arrays just above the current price action.
Dropping down into the 4-hour structure gives us the exact answer. Notice how price is expanding out of a deep discount zone and aggressively pushing into premium territory. The institutional narrative here is laser-focused. They want to mitigate a massive, completely unmitigated bearish fair value gap and a bearish breaker block sitting directly above our 43.66 target. That specific zone is acting like a giant, high-probability institutional magnet.
If you're trading smart money concepts, you know how crucial it is to understand how this fair value gap dictates price delivery. This massive 4-hour imbalance sits perfectly between $43.66 and $44.01.90. Because that premium rebalancing process is currently incomplete, all those buy stops resting just above $43.66, that's the path of least resistance for institutional capitalization. They're literally dragging price up just to fill this void. Refining things a bit further on the 1-hour time frame, look at those explosive, large bullish displacement candles rocketing up from the 42.18 area. That is pure institutional footprints right there, confirming dominant buying out of a discount. The 1-hour order flow has officially shifted bullish, validating a structural breakout. Price is now perfectly positioned structurally for one final continuation push higher, right into that premium liquidity pool.
But listen, we don't just blindly hit the buy button and hope for the best. The exact execution mechanics require a very specific sequence to play out. First, we absolutely must wait for a news-driven liquidity sweep. Second, we have to observe a clear, undeniable displacement on the 15-minute time frame. And third, we enter strictly on the newly formed 15-minute fair value gap. If that exact sequence doesn't happen, we don't touch it. No trade.
So what's going to kick off this whole sequence? The catalyst is hitting tonight. We have high-impact USD core retail sales data dropping at 7:30 p.m., followed immediately by a speech from the US President at 8:30 p.m. From an institutional standpoint, these events are literally just engines for liquidity injection. We aren't trying to trade the fundamentals of the data or the politics of the speech. We are purely trading the institutional volatility engineering that these events facilitate.
Now here's what that required setup trigger has to look like on the 15-minute scale. We need the news to cause a violent liquidity sweep of the minor intraday lows, forcefully dropping price down into our defined discount arrays. Right after that sweep, we have to see a rapid, aggressive displacement upward. I'm talking about a clean market structure shift that leaves behind a wide-open bullish fair value gap for our precise entry.
Alright, let's map out the exact execution parameters. Grab a pen if you need to. We are looking for an entry zone between $43.25 and $43.30, strictly after the internal sweep occurs. Your hard stop loss goes at $43.15, tucking it just below the unmitigated 1-hour structural support floor. Take Profit 1 is our internal swing high at $43.48, and our massive final target, Take Profit 2, is that external buy-side liquidity pool up at $43.66. That setup offers a fantastic risk-to-reward ratio of roughly 1 to 3.2.
But hold on, because this right here is exactly where amateur traders blow up their accounts. As of this exact moment, the status is strictly no trade. Smart money confirmation has not appeared yet. Price is just chopping around, consolidating inside an internal range. It hasn't given us a clean institutional displacement or a definitive structural shift that aligns with our higher time frame draw. In this game, patience is your institutional edge. We sit on our hands and we wait.
So while we wait for the setup to form, let's talk about the retail crowd. Where are retail traders about to get completely trapped today? Understanding exactly where the masses are hiding their stop losses is the key to identifying where smart money is going to sweep for liquidity before they initiate the real move.
The retail trap is set so perfectly, it's almost poetic. Most retail traders are looking at their charts right now, seeing a rock-solid support floor at $4,317.30. And a bit further down, there are glaring relative equal lows at $4,290. There's incredibly heavy sell-side liquidity resting below those levels. Retail traders are stacking their stop losses right under that perceived support. But institutions, they don't see a floor. They see a highly attractive target to engineer liquidity. And this is the exact scenario almost everyone else is completely ignoring. The highest probability path today is that the market algorithm uses that retail sales news to violently sweep those lower internal retail support levels early in the New York session. They'll trigger a cascade of retail stop losses, accumulate their own buy orders at a massive discount, and then violently reverse and expand upward to clear out our true target at $43.66. Now, you are definitely going to hear a ton of noise in the background today about macro headwinds. The news cycle is dominated by reports of an impending US-Iran peace deal over in Switzerland that's aimed at restoring oil exports, not to mention expectations of the Fed holding rates between 3.50% and 3.75%. And sure, those global macro events can trigger massive sentiment shifts, but our focus, it remains strictly on the chart's structural liquidity draw. We trade the footprints the institutions leave behind, not the headlines.
Let's do a rapid-fire recap of the entire institutional game plan. Our macro bias is bearish, but our intraday play today is a bullish retracement. Now, if we get a 15-minute candle close below 42.90, this entire setup is completely invalidated, because that signals an early breakdown. Our absolute target remains that 43.66 buy-side liquidity pool. And the golden rule for today, do not touch anything until you see that news sweep. And, as always, manage your risk, keep it to a strict maximum of 0.5% to 1% per trade.
If this breakdown clicked for you and you appreciate clear, no-nonsense institutional market analysis using smart money concepts, make sure you're subscribed to the ICT Market Theory channel. And hey, if you're looking to actually trade these exact setups with top-tier execution, you can find the FXTM account link pinned right down in the comments below. It's the exact broker we trust to navigate these high volatility conditions.
I'm going to leave you with one final question to chew on as we head into the New York session. When that high-impact data drops and those charts start moving violently, are you going to be the one providing the liquidity for the big players, or are you going to have the iron discipline to wait for the real setup and trade alongside the institutions? The choice and the patience is entirely up to you. I'll see you at the market open.